Hey, real estate rock stars, welcome to the whole enchilada of real estate investing, the only podcast that serves up the full feast of street smart strategies to build wealth and take control of your financial future. I'm Lou Brown, and I've been in the real estate game since 1976, so I've learned how to make the whole plate worth it. Each week, I'll be dishing out creative financing hacks and proven systems that help investors build multi-million-dollar businesses. No fluff, just the good stuff, straight from the source. Ready to dig in and start making deals? Let's get to it. Well, welcome everyone to another edition of the whole enchilada of real estate investing with Lou Brown. And man, today I have someone that I think you guys are going to be blown away by, who has done some amazing things in real estate. And Larry, I'm going to let you introduce yourself and tell us a little bit about yourself and where you're located and all that good stuff, and then we can create from there.
Awesome. Well, thanks for having me. This is a great opportunity to learn from you. My name's Larry Mastropieri. I am the broker owner of the Mastropieri Group based here in South Florida. And we sell about 200-ish properties per year. We transact at about 125-ish million in sales volume per year. And in parallel to all that, we buy investment property and hold for the long term, mostly multifamily. We do dabble in some single family residential stuff, but mostly multifamily. And now, as of probably next week, we're about to close on another building where we'll have about 130-ish units under management. And we've been doing this for 15 plus years. And we're going to keep it moving forward, right? So, yeah.
And that is remarkable. Now, I always like to talk about people's origins. So what got you into real estate?
Yeah. So believe it or not, so my mom has always been a real estate agent. So right there is probably the segue. But and my dad owned investment real estate growing up. He was an entrepreneur himself. So I came from a very entrepreneurial family. But I was going the path of mechanical and chemical engineer. I graduated with a mechanical engineering degree. I started to work for General Electric down here in South Florida. And while I was doing that, I got my real estate license, I got my mortgage broker's license, and I started to help people buy and sell homes. I also started to invest in real estate myself with a buddy that I grew up with. And over time, him and I scaled up that portfolio together with no outside investment. We are not syndicators. All 130 doors are owned by us, me and my childhood best friend. And yeah, at some point during that process of working for the corporate America, system, I made the decision that, there'd probably be more synergy if I hopped into the real estate market, became a full-time broker, and also invested in real estate alongside that. So in late 2018, early 2019, I transitioned from just part-time doing all that to full-time. So I spent about 9-ish years doing this as a side hustle, and then finally moved into it full-time. So I think that's like an important thing for young people to get. I spent 9 years doing that on the side, right?
Yes.
Getting good at it. So when I became a real estate broker full-time, it was like I already purchased and sold a ton of property for myself. I had done a bunch of transactions, and I was doing that all with the security of a very awesome engineering job that I reluctantly left. I loved it.
Oh, you love being an engineer, and then you transitioned into something, well, kind of engineered. And that's buying properties right, buying them cheap, buying them creatively, and being able to do what we love to do in this business, which is be able to have that long-term cash flow and long-term opportunity. So holding 130 doors right now is amazing and fantastic, and definitely a cash flow machine. Now, I saw something that you don't necessarily go towards cash flow right away, and that there's another angle on looking at cash flow. Tell us about that.
Yeah, well, I guess we could talk a little bit about just how markets are different, right? And depending on where you're investing and your investment paradigm, you may have different strategies, right? And so I wouldn't say we don't want cash flow. We love cash flow, right? Everybody loves cash flow. You can borrow against cash flow. You can do a lot of great things when there's a lot of cash coming in. And that is at the end of the day, the goal to generate a lot of cash flow. But in South Florida, it's kind of a unique market. It's expensive. Some people say it's similar to a New York City market on some level where the purchase price for most property is astronomical. And if you're buying into that kind of market, you're getting leverage at 50%. You're not expecting high cash flows, right? And you're holding for maybe appreciation, right? So I think there's always this game of cash flow or appreciation, and which one do I favor, or what's the balance I can strike there to have call it a de-risked investment, right? Because if you're playing the game, it makes no money or it loses money every month, and I'm betting on appreciation, that's pretty speculative, right? On the other hand, if you're right, yeah, I mean, you get this. You've been doing this forever. So like we obviously try to avoid that on some level. We're not trying to be speculative investors. We're long-term holders, and so really we try to strike that balance, which is really hard in South Florida to really leverage the property properly or an investment properly. 60 to 75%, maybe even if you're lucky, 80% LTV. You're unlikely to cash flow very much at all when buying property. But fortunately, South Florida has had a really good run on the appreciation front, right?
You made that connection between New York and Miami, right? So all the New Yorkers are bringing all their big cash to Miami and driving up the prices, right?
Yeah, I mean, the population growth here has been crazy. The interesting geography of South Florida is you have the Everglades on one side, the ocean on the other. And so you're kind of limited with land, right? And so you can go north or south, but north or south isn't always as interesting as being in downtown, right? Or whatever, right? And so South Florida, being limited with land and high population growth tends to drive prices up, as you mentioned.
It
Yeah.
really does. It really does. It's quite amazing and definitely interesting to get your perspective on a market like that, because we do have people in our ecosphere that are all over the country, from San Francisco to South Florida to New York, and they are definitely dealing with high-end markets and things like that. So for you to shift from the single family arena and get into the multifamily arena, what was the transition there for you to cause that shift to occur?
Me and my buddy, we were always buying multifamily from the beginning, or trying to. We were buying a duplex when we started, right? I bought a duplex myself. And the origin story is I bought a duplex myself, rented it out, the one side out to my sister and her friends, and I stayed on the other side, right? And my sister and I had lived together for part of our college career, but I was over living with my sister because she had all these dogs, and I couldn't stand just dogs and dirty whatever, just running through the house barking all the time. So I'm like, I don't want to move too far away from my sister. I don't want to abandon her. Let me go find a duplex and let me put her in one side. She'll pay rent just like she's doing right now, and I'll live in the other side, and we'll have some separation, but we'll still be close. We'll be great. So it was partially, initiated by that logic. And then also the goal was initially to kind of find this side hustle investment strategy that took me in the general direction of financial freedom. And so the duplex made sense, first purchase, then second purchase was another duplex walking distance. And then the next one was another duplex right next door to that. So we were doing multifamily from day one. I was just selling residential real estate for friends and sphere of influence people while I was buying multifamily and looking for it. And back then this was 2011. It was a good time to get into this, right? It was, I made a lot of mistakes and the market covered them all up. It was great. The values just kept going up, and I just learned lessons, and it didn't cost me the business, right? Yeah.
Yeah, that's the gift of appreciation, and inflation also is another reason that we kind of can't go wrong in real estate, because sooner or later inflation's going to just make up for it. But definitely there can be wrong turns. And, it's kind of interesting that my first investment property, not the first property I bought, but the first investment property was a duplex. So guys, that's another opportunity for you. He's calling it multifamily, and it is because they're connected together on the same plot of land. But there's so many creative things you can do with that, and definitely there's people that get into this business and they find out they're just not cut out to be landlords, and there's still opportunities that exist for that, and that you can do it creatively because they want to get out so badly.
Yeah.
They
What we found success in is, and even this recent deal has been really interesting, and they're far and few between recently, but we found success in tapping into the individuals that have been in this game for a long time, have held these assets for a while, and we call them mom and pops, right? Mom and pop owners that we can step in, buy the property, and do what we do, which is improve conditions, increase rents if possible, and refinance and remove some of our cash that we've invested in the deal. In a lot of our deals, we've took out all our money and some. And sometimes that process looks like 6 months. Sometimes it looks like 6 years, right? It just depends on how the deal goes. And obviously, getting your money out as fast as possible is efficient and helpful, so you can continue to scale further. But most of our deals, and we're looking at a lot of refinances next year. But most of our deals we're kind of clean out of. We've got all our money and reinvested it. We've burred, if you will, but on a longer time horizon than what the burr book would otherwise teach you, right? They usually say
right.
fix it and then 3 months later burr it, right? And refinance and repeat. But that's not South Florida really hasn't created that environment. It's a little bit more competitive than that, especially in the
Well,
multifamily space.
I look at the Burr method, and it just doesn't impress me for a lot of reasons, but one is the expense. By the time you've spent the money for the refinance and you're already jockeying around with cash flow, and that can be really used up in a lot of ways. So one of the things I love is seller financing. Do you do a lot of creative or seller financing?
Well, the deal, we have a 40 unit under contract in Titusville right now that we'll be closing on in like 2 weeks, assuming everything goes well, which it looks like it is. And that's a seller finance deal. So
Yes.
so yeah, so we're doing, we'll entertain that for sure. It's helpful for a number of potential reasons. You can get creative. You don't have to. One, it's easy just not have to go through the whole process of all the documents that all these lenders need, et cetera, et cetera. But also the seller might be more lenient on things like different insurance policies. In South Florida, insurance is a huge cost. And so maybe you can tweak the insurance policy where a standard lender won't do that. But the seller is like, yeah, we don't care. Let's just go ahead and do that. And then they get paid a little bit more because usually their interest rate's a little higher. And we save a little bit because we've kind of played with that insurance premium annually to keep costs down.
And how is it that you're able to save money on the insurance?
Well, in South Florida, as an example, there's different insurance type policies, but you have flood, you have wind, you have hazard, you have general liability. These are like the four things that you're considering when you're getting a loan on a property. These are things that lenders will require depending on what flood zone you're in, depending on different things like that, right? And that wind policy, which is very specific to hurricanes, is the big piece of the puzzle, right? And so maybe a seller doesn't care about you getting wind. Maybe they don't care about flood. Maybe they don't care about hazard. Maybe they only care about like, hey, just, if somebody sues you because they break their leg or something bad happens, let's make sure the insurance is really beefed up on that. Well, great. Okay. So maybe we can self-insure the other three and hold that. And that could be a difference between a $50,000 premium and a $5,000 premium, right?
Mm,
And so
that
now all of a sudden you clawed back 45 grand, and maybe the rate's a little higher, but you're net in the black there because you save so much on insurance.
Man, that makes a lot of sense, and definitely some great advice there, because insurance is such an ugly thing. I got hit with not one, but two hurricanes on a property that we're rehabbing up in Orlando. And oh, goodness gracious, that was so much fun. And it's, you get nailed big time on those insurance premiums for sure. So that's a creative way that you guys can take away from this and say, hey, if you're impacted greatly by insurance in your area, there's some variables that come with that creative financing. So that's a good one. Now,
That's just one example, right? I mean, there's so many other things you could do with creative financing.
I love it. I love it. And I love the fact that you're buying a 40 unit with creative financing. That's one of the things that I talk about is the same stuff that we teach for single family is absolutely transferable to multifamily, to commercial property, especially when you're working with a seller that needs to sell, not wants to sell, and they have the flexibility to be the bank for you. There's so much opportunity with that.
I think the key is for investors who are like getting into this, or even just normal investors, not to like pigeonhole yourself into like, hey, I'm a creative finance guy. This is what I do. This is all I do. We're deal guys like that. And that's what everybody wants to be. Like the more options you have in your quiver or whatever you want to call it, more options you have to like structure a deal creatively, the better. Right. And so like I get a lot of calls from people who are like, hey, I'm doing this sub 2 thing, or I'm doing only foreclosures. And I'm like, well, let's take a step back. Like, why? Oh, because that's where the good deals are. I'm like, that's not always true. Like there's good deals everywhere. This is a brokered deal that the broker came to us. This is from our network. He listed it. We competed. We saw the opportunity. We bid against 6 other offers and we got in there quick. And so that's how this one played out. The other one was off market. The other one was foreclosure at county auction. The other one was, you just go down the list. The other one's a sub 2. It's just like, okay, all these things can be an option. And so I think the game here is just be a legitimate investor, go out there, network, try to find the opportunities and do the deals that make sense. And you kind of need to get to a point where you're doing a fair amount of them in order to get the opportunities that you and I are discussing, right? Where it's like, hey, this one showed up. I haven't done a seller finance deal in quite a while, but it's not because I didn't want to. It's just because the seller had debt on the property and they had a unique situation. They couldn't do it or whatever. It just didn't work for that seller in the previous deals we've done. And so we created a different situation and did it differently. And that's, I think that's important. I think I just get so many calls what I would just argue are kind of like misguided. I want to buy foreclosures. It's like, well, what you don't need, like, if you're saying that to me, you probably don't even know what that means. Like, so let's start with that. Yeah.
Well, you think like I do. I always teach, don't tell the deal what it is. Let the deal tell you what it is. And then you can tap into the opportunities that exist. So I love that advice.
That's great.
That you shared.
That's
Yeah.
great. That's actually profound. I haven't heard that. And that's like that's the best way to describe it. Cause that's what happened to us. We came in, we said, hey, we'll pay cash. We'll finance it through standard financing, or we'll do the seller financing route. Here's the options. Here's how we could do this. And the guy was like, oh, I kind of like this seller financing thing you suggested. Let's do that. I'm like, great. We can close in 3 weeks because we don't need a bank. We don't need anything, and you guys will collect a check for the next 3 years. Great. So
I love it. I love it. In the after show, I've got another idea I'll share with you too.
cool.
But definitely there is so much opportunity when you're in the field, you're finding things that nobody else knows about. I love connecting with agents and say, look, give me all your pocket listings. Anybody that's even breathed that they might be willing to sell, let's go visit with them. You can earn up to a full commission. And so that's another, opportunity, guys, is that often agents know about opportunities, but the seller, for whatever reason, is not willing to list. And they're concerned for various reasons. So you just go, okay, well, can I have it as a pocket listing? Go find a buyer, bring it to you and get paid a commission. They say, oh yeah, you can do that.
Right.
They just don't want it on the open market for whatever reason they might have, which are varied and many. So tell us about your worst deal.
Oh man, I've had a handful of transactions that aren't perfect. We bought a deal. Again, this story. It's like a painful experience, but it all worked out. Maybe not as perfectly. And we could have probably done, and not probably, we could have done other deals. Me and my business partner reflect on this all the time. We should have bought this thing when it was offered instead of this thing. Yet we bought this thing, and this was a complete disaster. So we bought a 8-unit building in a rough neighborhood outside of West Palm Beach. We're right in down, like basically downtown West Palm Beach, very close. And so we keep telling ourselves long term, this is gonna like really pay us back. So like that's the now we're leaning into the appreciation speculation. It's like this is gonna appreciate a ton. It's gonna be great. Someday. Just hold on to it long enough. So we bought this thing. It was a complete mess. I mean, the building needed full reno. There were tenants living in it. I would say 50% or more occupied. But it was just terrible tenants paying like very little money, if they're paying at all. And so we took it over. We paid, I don't know, somewhere around 600, maybe in the fives, six or somewhere plus or minus 600 grand, a little bit. And this was 2019, fortunately. And we got in there. We went in there like gangbusters, which lesson learned, not usually the approach I take anymore. We went in there like, yep, everybody's out and we're renovating this place and we're gutting it and we're not going to pull permits and we're just gonna get in there and get out of there quick. And so one of the tenants stayed around the area and basically was still in the unit, like kind of coming back and forth because it was very hard to control these people. It was in a rough neighborhood. And reported us to the city. We got jammed. We got red tagged. So again, now we went from a budget that was like 150 grand spend to like, now we're dealing with the city. The city hates us. The lady that's in that unit suing us because we wrongfully removed her, which wasn't true. She left. It's fine. But she created all this headache for us in the meantime, had to hire attorneys, get them out, all this stuff. So she left. And eventually, after a lot of pain, and we ended up spending, I don't know, $350,000. And like the deal was probably worth what we had in it, right? Which is not the game we're playing, us personally, especially at that time. And so long story short, we spent a year and a half, 2 years getting this whole thing right, getting tenants in there. And to this day, there's still just nonsense that we're dealing with. And we were a little newer. I don't want to say newer, but we were newer to like a bigger project of that scale. We didn't really know how to handle like big GC projects. Not that we didn't, it's just like we weren't set up for it. And so long story short, we had the wrong people in place. They did the wrong things on the contractor side. So we're still like redoing things as they pop up.
You already paid for it.
That we've already paid for
that program
once.
too.
Yeah, right. So we learned all these lessons in this, and we learned all about the different things not to do. I mean, certain buildings have wood subfloors and versus concrete subfloors and like just different things that we just became very acutely aware of because we literally everything that went wrong could have went wrong. We had the building on jacks. Like we had to jack the building up because the termites damage was so bad in that building, and you couldn't see it until you started like doing the reno. That you pulled the ceiling down, and you're like, oh my God, all these subfloor beams are toast. So we just like, long story short, we were deep in that thing for probably $1 million, all in. And fortunately, my business partner and I were able to float this thing and keep it going because I think there would be a lot of people that would have had to tap out and just sell this thing after losing.
Sell it to people like us.
Totally, exactly. So I think the theme of the story is just like make sure you're well positioned financially to take on some of these bigger projects because things go wrong, and so those lessons from like multiple experiences, maybe a little less crazy than that, have translated in us to making good decisions in a very competitive market today.
And one of the things to look at, guys, when we share with you the best deals and the worst deals is the lessons learned, because these lessons learned are valuable. These lessons learned, even if you just zeroed out on the deal, still you now are so much more adept at buying the right property in the right neighborhood at the right time with the right things wrong with it instead of the wrong things wrong with it, right? And getting the right contractors, right?
There's so many pieces to this puzzle, right? And there's something to be said about momentum. Like once you're kind of rolling and you got everybody in place, there's like value to that. And you got to keep that momentum to keep that system lubed up and operating properly, right? That to me has become such a valid thing. Like momentum is what makes us efficient. And so there's people that are like, you're doing this, why are you pushing so hard? Well, the momentum is going to give us the ability to get to next level, get to the next level. Whereas if you lay off on your goals, on your mission, on your dream here, building a real estate portfolio, you lose that contractor that you had in your back pocket because you just did 3 jobs with him and he's going to bend over backwards to do the next job, or the real estate attorney that will pick up your phone call when you need them because you're just like constantly keeping them in the mix. And so what I've kind of done here is like built this like little bit of a momentum machine around the brokerage plus the acquisition side, where it's just like, let's keep everybody working, keep me sending business to attorneys and inspectors and general contractors and everybody, because when I need them for our thing, they're there and they're ready to go.
I like that. So momentum really is team, right? That you have the right team and you build the right team over time, and you have enough going in your business that actually feeds them that they want to stay with you. And that's great advice there. Now I let you tell you this, and I lead with your worst deal. Now, how about your best deal?
Yeah, that's interesting. It's the best deal. Let's see. There's a couple that kind of come to mind. Some of the best deals we've done, and it's hard to really quantify which one's perfect. This is the engineer talking. This is me like saying I haven't looked at exactly the perfect numbers, but anecdotally, I can tell you we bought a 4-unit and literally did nothing to it, but we bought it so cheap, haven't touched it really. And like every year you kind of look at that bank account and you're like, whoa, there's a lot of cash in there. And I haven't even heard of that. I haven't even, like, my property manager hasn't called me to be like, we got this headache here, or sent me the WhatsApp chat like, hey, we're replacing a whole bathroom because this went to crap, right? It's just like we didn't touch it, and we kept rents not crazy. We just kind of moved them with the market, and the thing just works. It's just like not something to stress about. It's not in this like super awesome location. It's not. We don't think it's going to appreciate a whole ton. It's not. It's just is what it is. We bought it at a good basis, and we just held the thing and just did what we had to do, keep the tenants happy, safe, and, clean property, but nothing like what I just discussed. And so that's like kind of the lesson learned here. Brokers call me and they say, hey, I know you want this like value. You want this, your buy box is like value add, this, that, and the other thing. I'm like, it's not value add. Again, back to the deal thing. It's like, it's deals that work, you know what I mean? And we've talked about how deals work, Mr. Broker. And so or Mrs. Broker. And so you kind of know what we're looking for, but it could be a finished product. It doesn't matter. You sell me a finished product at a good price. It just so happens most of those finished products are not selling at the prices we want. So yes, there's more value add deals that we do than others. And so the lessons from just doing a bunch of these transactions and kind of just reflecting on it and saying, well, what deals do I want to keep doing? What deals do I want to maybe not do? It's more of I don't need to get carried away like I did on that other deal. I could have just let that deal, if I can touch that deal, that 8-unit building that we bought, and just cleaned it up, made the property nice, didn't need to pull a whole bunch of permits, didn't need to get into jacking the building up because the city made us do that after we got jammed. And that's because we got overzealous and we had 7 units getting jackhammered and it's just crazy. If I just left that alone, that might have been my best deal, if you believe it or not. So it was entirely my fault, that deal. And I'd say this is my business partner because I'm kind of, he's based in New York. So I'm controlling most of the,
you're the boots on the ground.
Yeah. So and I have most of these your relationships that are contractor related. All I had to do was be all right, we're just going to rent this thing out for $900 a month per unit instead of $1,250, and just move the heck on to the next deal instead of pour another $300,000 into this thing. And so, for example, the new 40-unit we'll buy, the seller asked me, hey, what's the plan? He knows we're value add guys. So he was just are you going to come? I'm like, we're not going in like gangbusters. We're just going to take it, own it for a second, renovate a unit, see what the rents look like. Somebody else renovate that. And for us, that model works well because our sequence is probably refi year 2 in a perfect world, refi year 3, 4, 5 if we can't see enough cash out on the deal. And so the plan is buy enough of these things where every year you're refining something until you're not, and then you just start paying these things down. So when you're in scale mode, refi to buy more, then at some point, okay, let's buy these things down. Let's put everything at 50% LTV and just kind of cash flow.
Well, I know a lot of people are probably wondering, where did you get the money from to be in the business to build a 130 unit portfolio? And obviously, you've been talking about refinancing properties. Often people get started and they're not in a position to do that. So, did you have some initial capital that you put
Yeah,
together for that?
great question. So fortunately, we started in 2011. I had a good job. So I came out of school making, I don't know, $75,000 a year in 2010, which was a lot of money. And then I was also selling some real estate. So I'd make 20, 30 grand a year on selling real estate as a broker. And then I made that money. And so then I took, that 30 grand that I made in commissions and split it with my business partner and buy that $250,000 duplex and do a 75% down loan of some sort, something like that, right? Some version of that. Math maybe doesn't check out perfectly, but that's exactly what happened. And so we did that one, and then the next year or shortly after we did the next one. And so every single time we've done a deal, including to this day, the 40 unit is I'm spending all my money, everything I have, right?
Right.
So to get to this one, so we kind of know our limit, we know where we're at, and we're like, okay, we can handle this size transaction. Here we go. We're gonna do it. And fortunately, him and I have this, like, my partner and I, we have this thing where we got to keep up with each other. If he can buy a $3 million property, I should be able to buy one with him, right? If we should be able to buy it together. So if he has the cash, I need the cash. So we stay 50-50 and keep that going. And so the reality is, in my opinion, there's all different ways to generate income to buy real estate. You can be in real estate, you can be a wholesaler, you do all these things. You separate yourself from, this is my job, this is how I make money, and this is where I invest passively. And those two things are different, right? And so, like, the multifamily stuff is the passive investment for us. While we can refinance and collect some money and then reinvest it, that's great. That's not the whole plan. It's like, if the deals go really well, great, we'll be doing that. But if they just continue at the way they're going today, that's fine too. We'll just hold them forever. You really need to, on the other side of that, you really need to make a lot of money. You just need to make a lot of money. And that's where
So those that make a lot of money can qualify for loans, and it's not a problem, right?
And
Yeah.
so by the way, there was another buyer in that offer, that transaction, that was like trying to get in, and the seller looked him up and said, I don't like this guy. He seems, I can't find much on him. I'm not sure he's qualified. And then he looked up me and my business partner, Googled us both, and we popped up. And, I'm in the real estate business on the brokerage side. So my information's out there. You can see a lot of stuff. And we spend a lot of time on the brokerage side promoting ourselves and making sure we're there. So he looked us up. He's like, I like these guys. These guys showed me good income. They showed me this, that, and the other thing. Great. I like you. I like you guys. We'll do the deal with these young guys instead of this, like, 6-year-old guy who a little different. And so, like, what changed for me is, like, getting into entrepreneurship full time I was able to make more money. And then when I was able to make more money, I was able to deploy more money into my real estate investments. And so I think there's some level of, like, as an entrepreneur, you need to make a lot of money. So you can do this real estate thing. There's other ways to do this, right? But, like, again, people will be like, well, I do this wholesaling thing. Well, that's how you make money. You know what I mean? There's a difference between your job
That's a
and your
job.
passive.
That's not investing.
So this is my point. Yeah, exactly. So, like, your job, whatever that is, whether it's this entrepreneurial thing or you work at Goldman Sachs, you got to generate a lot of cash to go ahead and deploy it to invest it. Sometimes these investments can go well, but not always are they going to just, like, slam it out of the park. And you have to do a lot of them to get really good. So you need money to do this, or insert yourself in an environment where you can be a part of doing a lot of these deals, right?
Yeah. So you've self-funded this. You've used your own credit, your own background, your own experience, and your own cash flow to be able to put you in this position. Is that correct? You've not gotten money from third party other
Yeah.
than traditional banks.
Correct. Yeah. Just traditional banks. We've done, like, some bridge loans here or there, private bridge loans that we've paid back. But other than that, it's been, there's times where we've done deals where it's like an all cash deal and we had to go figure out how to come up with $1.5 million because we needed to close it. So we got this bridge loan for 30 days until the bank funded us the remaining balance, and then we got it done, right? Or whatever it is. So we've done these little creative deals where we know we're getting a better price because of this, and that worked out. But yeah, it's all
I
been
love
it's all
that.
been 50-50 funded, me and my business partner.
That's very inspirational, Larry, and you've given us a lot of really great input and positioning ideas, and you've been kind of soup to nuts through the whole game of learning the business, becoming a real estate agent, then a broker, then a mortgage broker, and an investor all mixed in there. So you've got a lot of really great foundational pieces to what you're doing and how you're doing it. I love that. And the fact that you're doing a couple of hundred properties a year as a broker, as well as also doing your own investing along the way, that is just a perfect match and a perfect mix of what you're doing. What can we do to help you, Larry?
I appreciate that ask, and vice versa. I'd like to know what I can do to help you. I can always use help. I'm not sure off the top of my head what help I need. My fiance would tell me I need a lot of help. So, so
That comes with the package, right?
yeah, I'm happy. I'm just happy to connect and see where opportunities take us. So, anyone can feel free to reach out, and if I can add value and you can bring value, et cetera, like let's connect. So you can reach me. You guys can Google me. Yep, and that's probably the easiest way to connect. So. Yeah.
Perfect, perfect. Larry, thank you so much for being with us today on another edition of the whole enchilada of real estate investing with Lou Brown, and we will see you again soon. Yeah, baby.
Thanks, man.
Thanks for tuning in to the whole enchilada of real estate investing. I hope you're feeling ready to take your investing game to the next level. If you're serious about building wealth, you won't want to miss the Millionaire Jumpstart. It's a 3-day live event that's perfect for any level of investor. Whether you're just getting started or you're looking to scale, this can be one of the final steps of making real wealth happen. So, what are you waiting for? Enroll now at millionairejumpstart.com and get ready to make big moves in your real estate journey. I'm Lou Brown. Until next time, keep hustling, and remember, it's not about how much you make, it's about how smart you play the game.